Most CEOs, founders, and business owners are bringing a knife to a gunfight. This is what I learned as I talked to what I call the private equity prodigy. So don't get washed away by the rising tide. Don't get crushed by the competition. This is going to allow you and your business to go nuclear. And it's not what you think. It's not AI. It's not automation. And it's not technology. So let's dive in. Enjoy.
Real estate. 2021, 1 in 7 homes was purchased by Wall Street.
Yeah.
2022, 1 in 5 homes was purchased by Wall Street. 2023 is about 1 in 3 homes purchased by big funds on Wall Street. These are residential homes. Mm-hmm. We are seeing, if you've ever wondered, where are all these cash buyers coming from?
Right.
Big funds. The World Economic Forum says, you will own nothing and you will be happy, right? You've heard that before.
Right.
We need more regular people to launch funds and democratize this. I'm not okay with 1 or 2 or 3 firms controlling everything. Right. I am okay with 10,000 independent firms all competing and fighting and making a competitive marketplace, because that drives down ultimately prices for consumers. Our mission statement is to democratize Wall Street. I truly believe we need to democratize Wall Street. And if we don't, we will be slaves to 3 companies who are taking over the world. BlackRock, State Street, and Vanguard control roughly $20 to $25 trillion of assets. They are the top 3 shareholders of like 475 of the Fortune 500 companies. They control everything. If you wonder who runs the world, it's BlackRock, State Street, Vanguard. Is go into a blue ocean. Don't make something better, make something different.
You should be proud, so you gotta have a lot of conviction.
Or you have to be a business mind.
AI is literally the solution in everything.
So just know that there will be changes.
To start or scale a business,
you should know from your mission.
Welcome back to the Founders Talk series.
So first of all, what is marketing?
To just do it. Welcome to Founders Talk, brought to you by the 5-Minute Startup. This is an exclusive interview with Bridger Pennington. He was a 22-year-old prodigy who launched his first multi-million-dollar fund and has since become a transformative figure in the world of private equity and fund management. With over 200 funds that he's either launched or helped launch through his program, Fund Launch, Bridger is making more wealth creation vehicles available to you than ever before. He's here to share some insights that should, not could, transform your approach to investing and entrepreneurship. So today we'll discuss the trade secrets on how exactly to launch your own multi-million-dollar and even in some cases billion-dollar fund without needing connections to Wall Street or a Harvard pedigree background. So diving into segment 1, we're going to talk about Bridger's background, where he comes from, and more. My goal is to show you that if he can do it, then so can you. So Bridger, starting out, I want to just ask you how you're doing today. Thank you for coming aboard.
Yeah, good intro there. Wow, I feel just honored to be here. But yeah, doing great. The market's been wild the last couple months. We can talk about that as well. But I'm heavily in the markets and with a lot of funds right now. We talk with our managers pretty much every day on what's working, what's not working. So it's been a very interesting time to be in the markets with all the tariff war and stuff going on. But anyways, so far it's been pretty fun.
Yeah, this is going to be an interesting moment to actually have this conversation because as we know, we're kind of like in this point, in this moment that can go any direction, and then no matter the direction, with the right vehicle and the right business and the right opportunities, you still can come out ahead. So that's why it's such an exciting moment to have you. And
I'll add that too. It's funny. A lot of people think, oh, like I'm all worried. Volatility creates a ton of opportunity for the people to take it. We started our business during COVID. I'm sure we'll get into this, but we started during COVID. We did out of college fund launch. We had $2.5 million in revenue our first 12 months. And we started like the 2 weeks before COVID dropped. We were college students, and it was like, let's just take advantage of the market we are in. And I think right now there's a lot of, anytime the world shifts, there's a lot of money to be made in the shift.
Yeah, absolutely. And launching that, during the rough times, obviously that prepares you for good times, Bridger. And one thing I want to ask you before we get going, because I understand how powerful this vehicle of a fund, launching funds and things of that nature, how much more powerful they are for an entrepreneur. So starting out, what would you say is the reason that you are so generous to share like this, what I call like one of the best secrets of our generation?
You're talking specifically around funds, correct?
Exactly.
Well, in the nature of my story, I was blessed enough to have a dad who worked in this industry, a deca-billion-dollar fund manager, and a brother who's an investment fund attorney at the largest fund, one of the largest law firms in the world. Now has spun out and is doing his own fund. I'm in a unique position. I didn't go to Harvard. I didn't work on the Wall Street. I didn't have all these. I'm in Utah, for crying out loud. I'm in Salt Lake City, Utah.
Yeah.
So how did someone in Salt Lake City, Utah figure out this world of, to launch their own private credit fund or own hedge fund or own GP stakes funds? I run 2 of those right now. I feel incredibly blessed to have a dad, a brother, and a great network that has been given to me, and I want to share that with other people. And so, we can dive into our story a little bit, but I had no clue my dad had any money really growing up. I had no clue they were running these huge funds. My dad's a very conservative dude. And come in college, I find out he has all this wealth, and he started to teach me about funds. I pitched my dad for money. My dad said, no, I'm not going to give you any money. And that spurred me on to wanting to say, well, and it worked well for me. And I was able to launch a fund in college, do very, very well. And I said, wow, what else can we do with this? And a lot of people started asking myself, my dad and brother about all these things. And so we started to make content online. It got bigger and bigger. And now I think we've around over 100,000 people have taken one of our courses online.
Wow.
In funds. We've incubated around 300 funds we've launched the last couple of years. We're now investing into our own funds. So we've invested into 6 portfolio funds last year with an average commitment of about $1 million per vehicle. And we're trying to do 20 more in the next 18 months. So anyways, it's a fun game to be in. And I think that's a part of it's, where I came from, a part of it's where we're going. But furthermore, I think our mission statement is to democratize Wall Street. I truly believe we need to democratize Wall Street. And if we don't, we will be slaves to 3 companies who are taking over the world. BlackRock, State Street, and Vanguard control roughly $20 to $25 trillion of assets. They are the top 3 shareholders of like 475 of the Fortune 500 companies. They control everything. If you wonder who runs the world, it's BlackRock, State Street, and Vanguard. To give you a sense of this, a decade ago, they pushed this ESG agenda, which was environmental, social, and governance.
Right.
And it was like overnight, every single Fortune 500 company started to mandate you had ESG initiatives. So you started to see Walmart, Apple, all these companies, it felt like overnight. The question was, how did all these companies, they're independently run, they're in different parts of the country or world, all of a sudden, in the same moment, all decide, yeah, we're going to do ESG. That's a big push for us.
Right.
And if you look at it, what happened was BlackRock mandated every company in their portfolio had to have an ESG initiative.
Okay.
Otherwise, they're going to sell your stock. The question is, like, for a CEO, what's the number one job of a CEO? Right. The number one job of a CEO is to return and increase shareholder value. That is it. There's nothing else. Like, everything else is sub to increasing and returning shareholder value. And if your largest shareholder, BlackRock, tells you to do something, you will do it. Right. So what happened was all these companies, this is like 2010, 2011-ish, all started doing ESG initiatives. And then what happened around 2020, 2021, BlackRock actually came out and said, well, ESG really didn't work as intended. People did a lot of different interesting things. They actually rolled back. They said, you know what, we're not going to make anyone do ESG anymore. We're rolling this back. This actually was kind of a failure. It had the right intention, but the wrong execution. Isn't that interesting about it? And then all these companies now just are doing whatever they want now. And so you go, oh, I wonder who runs the world. That's, the largest shareholder of the largest companies in the world. So when I go back to a mission, our company's mission statement is to democratize Wall Street. I want more people to understand the game of funds, how funds are built, how they work, how the most powerful vehicles on earth are used to really democratize Wall Street. I believe more people need to understand this game and what's being played.
Yeah, it's definitely a Robin Hood situation, right? Like taking the opportunity from only the rich and making it available to everyone. I think it's really important to harp on that point where a lot of times I say, personally, we need more entrepreneurs. We need more people creating value. This is going to make more competition and drive the markets to be more reasonable from a price point perspective for the end users. But when you think about it like this is like that 10x version of that opportunity where you can actually be a market maker by launching a fund and being able to buy, control, or influence massive amounts of businesses. And this is something that, if I'm not mistaken, anyone really could do, but there's a process and there's knowledge and there's a team and there's all these barriers to entry that can be removed. Am I right about that? This is something that almost anybody could actually do, right?
Well, I would say this. I agree with you. Entrepreneurship, statistically, is the best thing possible for countries. You take third world countries, if you there's an increase in entrepreneurship, poverty goes down, medical, supply things, everything gets better in that country when entrepreneurs, and I'm talking from the country, ground level entrepreneurs start building businesses. It's one of the best things on earth for people.
Absolutely.
With a fund, all a fund is if you have a business venture, you're an entrepreneur, and the number one thing stopping you from scaling is money. A fund might be the best solution for you. We have people right now that are, they run they run one, we mentioned this earlier, HVAC company.
Mm-hmm.
And the thing stopping them is capital to grow. And so someone could come insert 10, 20, 30, $40 million. We go purchase 11 different HVAC companies around their region. We then roll them together into one. That'd be a roll-up model. And all of a sudden they've now scaled. Other people we have a guy that was doing fix and flips. He was flipping about 4 houses a year on his own money, some hard money lending fix, which was good. He made good money. We set up a fund with him. The next year he flipped 72 homes the next year.
Nice.
So from 4 homes to 72 homes. And with those 72, he gets better, economies of scale. So average cost per flip went down. He made more money. So this is a vehicle to scale. So to echo your points. Now, can anyone do it? No, I'm just going to flat out say no. It's not for everybody. This is for people who are, and when you take other people's money, it's a very serious endeavor. Historically though, it's only been for the people on Wall Street and ivory towers. Is it just for them? No, as well. Okay. Right. This is for regular people around the world can do this. You got to be smart. You got to be sharp. You got to know what you're doing, but it's not just reserved for someone who went to Harvard or Yale or Stanford either. Right. This is something that regular people can do. Mm-hmm. And that's what we're helping people do.
Got it. For someone who, let's say I'm an entrepreneur and I started my first business, I started an HVAC company. I'm up to 10 trucks and let's say we're doing $5 million a year. Would the model typically be something where you always do, they are not always, there's no always, but you typically would wrap up other HVAC companies, or could you go to other, I would say, whether it be a sector difference or other specific types of services, like you have HVAC, but then you also have plumbing. So you could roll up plumbing companies as well. Is that a type of model as well, where you not only just go deep, maybe go wide as well? Or what would you say about that type of approach, just so people can understand where this works and where it doesn't?
The cool thing about funds is it's up to you.
Nice.
If you can show me a model where that makes sense, then you get to decide. And there's so many different types of funds. There's some funds that through, the traditional roll-up model. So they centralize, they have 10 trucks, they go to 50 trucks, and they centralize marketing, finance, HR. It allows them to have, instead of having 10 HRs and 10 finance, 10 accounting groups, they just have one. They centralize it via economy of scale. Generally speaking as well, you trade at a better multiple. Right. So if you're doing, $1 million a year in EBITDA, you'll trade at, I'm just throwing out numbers. I don't really know the numbers. Let's call it a 2 or 3x multiple on EBITDA, which is just let's call it net take home, your net take home at $1 million. But if you net take home $10 million, you won't trade at a 2 or a 3. You'll trade it at like a 5 or a 6.
Right.
There's a different multiple you get just by having volume or scale. So that's one way. You just mentioned another route. You can go adjacent services. You say, hey, we do HVAC. We're also going to add electrical and plumbing, and we're going to be an all-in-one shop. And there's a certain strategy around this. We see this a lot with software companies. So software they have maybe they're a website builder. Okay, they're a website builder software. They'll launch a fund and they'll go buy payment processing. Okay. And they'll buy, because everyone that builds a website probably needs payment processing. Right. And they'll buy like a funnel builder service and a copywriting service and another service, and they roll them all together in this one big conglomerate.
Right.
There's a reason, you go look at these big businesses that are huge. A lot of times they used a mergers and acquisitions fund activity like this to scale. It's one of the big catalysts for them to scale. And many, for myself included, for a long time, I thought as a small entrepreneur, I was like, well, I'm just doing my little business. I'm bootstrapped. I'm just doing this little thing. And I go, well, I'd go to courses and coaching stuff and read books. And that's kind of how they all play. And then I looked at, well, what are the big dogs doing? What are they actually doing? What are they, I know they say something, but what are they actually doing? I actually track this a lot. I did this last week. I go, Pace Morby, Cody Sanchez, Ty Lopez, Russell Brunson, Alex Hormozy. I've met, I think, all of them actually. Yeah. And we've talked with them. I was with Pace just a few weeks ago. I was with Russell like 6 months ago. They all teach different things, right? Russell Brunson teaches funnels. Pace teaches seller finance. I go, watch what they're doing.
Right.
What are they doing? Pace Morby just launched a $100 million fund.
Right.
Grant Cardone runs he was a sales trainer for like 15 years. What does he do now? Right. Cardone Capital runs a $4.5 billion fund. That's right. What is Russell Brunson doing? Funnel guy. He's acquiring companies at scale right now. They're doing full acquisition mode.
Wow.
Alex Hormozy and Layla, we went boating with them out in Bear Lake here. Before they were famous, we were friends. Now they're famous. I don't talk to them as much anymore. Yeah. But before they were famous, we were friends. They're doing all sorts of cool stuff now. But they bought our program. They were like, I'm going to do a fun thing. We talked early days before acquisition.com. I'm like, dude, you could scale this way. Yeah. And now what are they doing? Ta-da, they're doing private equity. What is Cody Sanchez doing? Private equity. This is the game. I always say, people, watch what people are doing. not what they say they're doing. What are they actually doing? And all these successful people you see online, they are all moving into the fund space. And I've worked with a lot of them because we're the fun people, we're the fun guys. And that's where they're moving. They're trying to play this bigger game because it's such an incredible vehicle to be in. If you look at the Forbes 100 list, the Forbes 100 list of billionaires, the number one asset class is fund management, is money management. Number two is tech. Number three is fashion on the billionaire Forbes list.
Okay.
So there's an old saying, the number one asset class that makes millionaires is real estate. You've probably heard that before.
Right,
it's made
of course.
more millionaires than anything. The number one asset class or industry that's made billionaires is private equity.
Wow.
So it's just very similar to real estate for millionaires. Private equity is to billionaires. So this is the game that most people are ending up in one day if they're successful in any degree.
Right. So to distill this a little bit, on this show, we talk a lot about the early days, getting your unit economics in your business together to where it becomes scalable, right? So as you get more customers, those customers pay for more customers and things of that nature. It's almost as if you can look at that initial phase, get that business working in the exact way that you want it to work, and then scale that. And then you utilize this as like your jet fuel to go to the moon, basically, when it comes to that business or scaling that business or scaling that portfolio like that. Is that kind of a way to look at it for an early entrepreneur who wants to understand long range wise how they can actually apply this?
I'll use that. I like that analogy. It's again, like I said before, if you have a successful business or investment and the only thing stopping you is capital,
right?
You could bolt on a fund to it, and it would that would be the booster rocket engine that would take you up, right? So I mentioned earlier house flippers. The only thing stopping him was just capital to do more flips, or buying a 50-unit apartment complex or a 100-unit apartment complex. The only thing stopping someone who's already good at real estate is just capital. A fund might be the best solution for you.
Right.
I'll share a different example. This was a guy, he called me up. He ran a gun store. Okay, so he had a gun store. He's like, Bridger, I want to scale. I got my gun store. It's doing well, but I really want to scale and see what I can do. And I said, okay, what's going on? He says, I want to buy out my competitors. He goes, what are my options? And I said, well, your options are this. You could do the Shark Tank route. You pitch, hey, we're going to give up 20% equity for $500,000. You know how they do that in Shark Tank, right?
Right.
You got Kevin O'Leary there and whatever.
Yep.
Okay, that's one route. You can give up equity. The other route, like you could go get debt from a bank. Okay, so you go get a loan, an SBA loan, then you go up. Oh, I'm getting balloons on my screen. That's pretty fun. You get this Apple. It's like, have you seen this, by the way? So I'm getting fully stopped. Apple's put like these filters on and if I do certain like hand emotions, I get balloons or lasers or thumbs up. Yeah, it's funny. Anyways.
Is it doing it to you now because I did that?
Yeah, there you go. So that's, anyways, the gun store, right? So you could do equity, Shark Tank. You could do debt. You could do like a seller finance, something like that. And then I said, well, what if there was another option? What if you started an outside fund? You leave your business as is. His business at about 10 million a year. I'm like, okay, leave your business as is. Don't touch it. It's the same. You launch an outside fund. That fund is going to raise X million of dollars. We're going to go buy your 7 competitors in that fund. So we go buy all 7 competitors in your area. Boom. We acquire all of them. They're now owned by the fund.
Right.
Furthermore, I said, well, you're good at running gun stores, right? He's like, yeah. I'm like, okay, the fund is going to contract your existing business and pay a licensing fee and a management fee to you to help come manage and service the 7 companies we just bought.
Nice.
And so you can put your branding, your logo, your sales training into all 7 of these. Now they're still owned by the fund, and you have your existing business if you're following along this little diagram here.
Right.
But now you control those 7 businesses, and furthermore, you own the fund. So you get paid through the fund's returns and now your own business returns, and you didn't give up any equity in your original business. Hopefully that made sense. Again, you leave your business as is, you start an outside fund.
Right.
That fund goes and buys your competitors and then contracts your original group. Hey, help, put branding on here, help us with advertising, help us with employment. And you now stock all those. There's an old, phrase from John D. Rockefeller. He says, own nothing, control everything.
Yep.
And that's a way, it's like, oh, shoot. That's how people move. That's how they move faster. They're controlling a market. They become a small monopoly in a certain region of the country because they bought out all their competitors through that. So anyways, back to the original question. If money is the thing stopping you from scaling, a fund is a really good option.
Awesome. Yeah. And so hopefully that's clear for everyone. I think a lot of people will think of this as something that's inaccessible to them, but the literal thing, the most important thing is, do you have something that if you just injected jet fuel to it, it can grow quickly. So backing up a little bit, you talked about when you first launched your fund, and even your dad said no, if I'm not mistaken, right? That's been a story that you've talked about. Like, hey, I wasn't able to just go with daddy and just get money. My dad told me no. As a matter of fact, he was harder on me probably than any other investor would have been when it comes to starting this. So could you talk about that early phase when you were in school? Obviously, you talked about COVID, which was like one of the craziest time to launch something, but you were still able to do that and do it successfully. Can you tell us about that initial time, basically not having a background in it and getting started? Because if I'm not mistaken, at that point, had you done any other businesses that you would say I can go and scale this specific business already? Or what did that look like?
After high school, I went on a 2-year church mission to Taiwan.
Nice.
I was a full-time minister and missionary.
Mm-hmm.
I learned Mandarin Chinese, so that's all I did.
Nice.
From ages 18 to I came home right after my 21st birthday. And I always say, like, I freaking knocked doors for 2 years and taught religion in another language.
Wow.
Everything after that is easy. Getting rejected by investors, it's easy. Selling religion door to door is a very hard thing to do. It was for the Church of Jesus Christ. It was awesome. I love my mission, by the way. I love the Taiwanese people. I love the Chinese language. It's awesome. It was so fun, but man, it was hard. And so I came home. I was ready to go. I felt like I was kind of behind because some people, they didn't go on church missions. And I was, I'm now a little bit older. I'm like, I got to get going. So I hit college running. I started 6 businesses my first 2 years of college.
Wow.
I tried pretty much everything I could. I went to BYU, Brigham Young University. I got there. I started a Chinese tutoring business. I had like 7 tutors that were tutoring local kids in the area that wanted to learn Chinese. We were teaching and tutoring. That business, hard to scale. My next business, I wholesaled 2 houses. I did a different business. I was building websites for people. I pretty much, if you typed in on YouTube, like how to make money, I tried all those businesses. Okay.
Right.
I was that guy. So finally my dad, he grabs me and he's like, Bridger, you're kind of like a chicken with your head cut off. I want you to go meet with my business partner. This guy can really help you out. I'm like, okay, I'm a young hustler. I'll go do whatever, So I was like, I'll go meet with this guy. So I drive to his house. I pull up to his house. He lives in this huge mansion. And I'm like, wow, this is a big house. He got, pool in the backyard, basketball court in his basement, cars, the whole thing. I go knock on his door. I walk in. And granted, my dad, nothing bad. We just grew up in a normal house, right? My dad drove a car with a dent in the door his whole life, and nothing bad, nothing great either, though. And as I alluded to earlier, I talked to this guy. I'm like, how did you get all of this? Like, how did you do this? And he goes, Bridger, when I was in my 20s, I was a lot like you. I was chasing every different business opportunity. And then he goes, then I figured out the secrets of the ultra wealthy. He goes, the ultra wealthy families of the world, they send their kids to the best universities. Sometimes they cheat to get them in. And they want their kids to go work in the fund management space, private equity, hedge funds, venture capital funds, or come back home and run the family office. He goes, a few years ago, I saw this and I said, I'm going to figure out how to get in the fund game. And he goes, today we manage about $8.5 billion of real estate under our funds.
Wow.
That's how I've generated a bunch of money here. And I was blown away. I was like, wow. I said, hey, can you be my mentor? Can you teach me? Can I come by? I'll do whatever you need. Like, let me come, I'll be my mentor. And he said, Bridger, go talk to your dad. Your dad knows way more about this than I do. I said, no, my dad's kind of broke. I want to learn from you. And come to find out, he goes, me and your dad are making about the same amount of money. And my chin dropped to the floor. I was like, huh? Like, come again? Like, why haven't we able to, we don't go on vacations as a family because it's too expensive. We're saving money over here. And yet my dad's running a $8.5 billion family of real estate funds. Yeah. So anyways, I left the dude's house. I go straight to my dad's house. I'm like, Dad, what the heck?
Right.
Like, what's going on? Like, why, what's the catch here? And anyways, he kind of laughs and smiles and says, yeah, my business partner likes to spend his money. I like to save my money, but overall, yeah, we run these funds. To make a long story short, my dad started teaching me about investment funds. So every Sunday night I'd go to his house, he'd get the whiteboard out and we would scribble on a whiteboard how funds are built, what they're looking like. I'd go to his office, we'd think through it all together. And there's a funny thing about life is when you start to learn something, you start to recognize that thing in your life. If you've ever bought a new car before, right? You start to see that car everywhere. Right. It's not like there's magically more cars. It's just you start to pay attention to that thing. The same thing happened to me. So I started to learn about funds. I started to pay attention to opportunities for funds around me. I was in school at the time. I was working a job and an internship at the same time. At the internship I was at, I saw an opportunity where we could do financing for clients that were coming through this business. And so I I talked to the founders of the company. I was like, hey, and we brainstormed together on doing this financing option for these people. And it was a very cool fund idea. I took it to my dad. We whiteboarded it all out. And I was like, dang, we got this awesome fund. I'm 22 years old at the time. I was hyped. I was like, we're going to launch a fund. And so I got this whole thing set up and built out. We got all structured together. And I was like, okay, crap. How am I going to raise money? Like, I'm inexperienced. I'm young. I got nothing going for me. Who's going to give me money? And then I thought, aha, my dad will give me money, right? Like, right. Duh. And so, as you know, we kind of alluded this earlier. I went and pitched my dad for money. My dad lovingly said no. He said, if I invest in your fund, it would ruin the experience of you raising money on your own. This will be a crutch that you'll never be able to recover from.
Yeah. Wow.
And he kicked me out. And I kind of walked out with my tail between my legs a little bit. And until, this is years ago, until just a few weeks ago, my dad has never invested in a single deal, property, project, anything I've ever done. Wow. But he was a great mentor and coach and said, okay, let's go do this. And so I took him up on the challenge. And then just actually 3 weeks ago, he wrote his first check into one of my funds. It was Fund Launch Partners. We just closed a $30 million fundraise. He wrote his first check ever. This is like 7-8 years ago. Yeah. And he wrote his first check. So anyways, I finally got him. I finally closed him. Yeah. But anyways, back to the story. So I leave his house. I hit the streets. I talked to everybody I knew. After about 4.5 weeks of pitching people, I raised a whopping $49,500 from, I think, 6 or 7 investors, which is teeny. If you know anything about investment funds, that's probably the smallest fund to ever launch ever. But it was enough to get started. We launched this teeny little micro fund. I started doing loans. Our first group of investors got a 64% return on their capital. Wow. So small amount of money, but good return. We did extremely well with their capital. We then rolled that fund into a second fund. That fund, we raised and deployed millions of dollars out of that fund over the next few years. Okay. I did roughly, I think, well over 250 deals we did through that fund. We did these small short-term loans, fast turn loans, and we did extremely well. That fund I ran for 3 years. I believe our returns were 62, 47, and 36% cash on cash return for the 3 years we ran it. Right. We then had a competitor come and actually give us an offer, and we exited that fund. Nice. So, which was awesome. So I sold that fund. After, during that time period, I mentioned this earlier, but we've had a lot of people starting asking us about how funds are built. How did you do this? So we started to make content online. I started a podcast and a channel, then social media stuff. And then it just grew and grew. Now we have, 100,000 people have taken one of our courses online through Fund Launch. Yeah. We now have a full incubator program that we help people fully launch their fund. We've launched 300 plus funds out of the incubator. Collectively, our clients manage $4.7 billion under management that have launched out of and through Fund Launch, which is pretty cool. Yeah. And then now we've launched Fund Launch Partners. We're now investing in their funds. And I run another fund called Ugly Unicorn. It's a crypto and blockchain investment fund. We manage about 25 million. Okay. And we're all in the crypto space. So that's the route we're on. We've been doing that for years. There's a lot of small sub stories mixed in there. During COVID, I ended up dropping out of school. We launched Fund Launch and crushed it during COVID. And there was a lot of stuff that happened. But anyways, I'll stop talking. We can dive into any of those stories if you'd like, David.
Yeah, one thing, because you mentioned the word exit, and that's the that's the championship ring of entrepreneurship. Could you tell us a little bit about, like, how long did it take from launching your fund to actually exiting your fund? Could you tell us about that and kind of what that process typically looks like for someone, just to simplify for those that are hearing this for the first time?
It's very unusual to exit a fund. Okay. Not unusual, but less common. The goal of most funds is not to exit. We had a unique scenario. We had ran that for, I think, let's call it 3.5, 4 years total. Mm-hmm. We were kicking out one of the competitors in the space was losing all of his deals to us. Okay. We were just, it's a very small niche market. There's really only 2 or 3 competitors in the space. Mm-hmm. We had quickly grown and we're grabbing a lot of market share. Mm-hmm. The one competitor said, hey, I don't like this. I will give you an offer. So he was a strategic buy for him. He called us up. He's like, and I said, well, if we're going to do this, you've got to pay out all my investors back their original capital plus all their returns. They got to be paid out and exited fully. And then you can take all of our contacts and everything else. So we did that. We exited the company. We returned capital to all investors plus all their returns. And then he bought our book of loans and all of our contacts and relationships and everything. We had non-compete and stuff like that. So that's how that went about. Generally speaking, though, most funds don't exit. That's not the goal of a fund. Right. Funds are so lucrative. The goal of most funds is you launch the next fund. And so a lot of times you launch fund 1, then fund 2, then fund 3, then fund 7, 10. You see companies like Sequoia Capital or KKR or Blackstone. They now manage $500-600 billion in some cases. They're doing pretty well. It's produced some of the wealthiest people on earth. Mm-hmm. It's crazy. So more unusual. My 2 funds I currently run, I plan to run them for decades. I'm relatively young. I've got a long runway.
Right.
And furthermore, I think about this a lot in terms of entrepreneurship. I've joined a ton of programs. I read all the entrepreneurship. I'm in the weeds of entrepreneurship. You know, I
Right.
do this a day in and day out. Something that stuck with me a lot. Most entrepreneurs that, or at least I was around, and even myself, at the beginning, at least I was a wantrepreneur, right? I wanted to be an entrepreneur, but I liked discussing entrepreneurship. I liked listening to the podcasts and, talking to my buddies like, yeah, we're going to start a business one day. But I didn't do anything.
Right.
I was a wantrepreneur. And I finally made the jump of like, no, I'm actually going to do stuff. I'm going to execute. So then I became an entrepreneur. Which was a big jump. The next leap for me, I'm talking mental frames, was a lot of people look online for a side hustle or a quick cash grab, or how quick can I exit, or and there are certain scenarios where people just hit the lottery and they just get lucky and they whatever. But generally speaking, the mentality that's moved for me, number one, you don't just luckily or fake someone out when you sell your company. You got to have a really strong business to exit.
Right.
I mean, it's got to be phenomenally strong.
Right.
Most businesses can't exit because it's just a person. It's not even a business. It's a glorified job,
Exactly. Yeah, for sure.
The second piece though was for me, I was like, well, what's the goal of exiting? I mean, it's cool to have a bunch of money. I've made good money. I mean, really good. I made phenomenal money. I know a lot of people that have exited companies that are extremely depressed.
Yeah.
And I was like, that's interesting. Yeah. So it doesn't equate happiness. They sell their company. They're extremely depressed. You look at lottery winners. A lot of them get very depressed. They go bankrupt. I'm like, that's interesting.
Yeah.
And then I thought, well, what gives me most life satisfaction? And you see a lot of entrepreneurs that stay in the game just because it's so fun. Now, they're not working 80 hours a week anymore. Maybe they work 20 hours a week, but they still use that muscle. And for me, I sat here, I'm 29 years old. I'm still in the game right now. And I said, I want to see how good I can get. How good can I be? Now, I have a family. I have 2 kids. I love my family. I love serving my church. I have all different assets in my life. I don't want to work 100 hours a week ever. Like, that's not the goal. But man, can I work 30 hours a week and or 40 hours a week and see how good can I achieve excellence? My favorite days are days that I hit my pillow and I'm worn out. Me and my wife have had like 5 or 6 days in a row like this. And I switched the mentality of trying to avoid work, because I think most people think of the exit so they can avoid work, versus work is what gives you life satisfaction. It's actually, now work I think is a broad definition. You can work on your kids. You can work on your body fitness. You can work on your business. You can work on your golf game. You can work on a charity. But I mentally said, I'm going to work every single day until I die, because that's when I'm happiest. Now, I'm hopefully not going to work for money every day until I die. I'll work on my kids. Hopefully I have, grandkids and great grandkids, and we want to build an amazing family. I work, there's other ways to work, but, and so then, sorry, I'm bringing this all back together of, I was in the wantrepreneur. Can I just talk? And then I was like, entrepreneur, get rich quick, something really fast. And then now I've moved to, I want to play the long game. I want to build something that's extremely excellent. I want to see how good I can be. And I want to find joy in the work. Because, the favorite part when we watch the movie is the Rocky cutscene, or we watch like when they went in the bat and they're training, they're building. That's the favorite part of the movie. For me, in most movies, I'm like, when they're building, they're putting it together, they're like tinkering, like that's where the value. And when we look back in our lives, when was the most growth happen, the most value, the most life satisfaction? Usually in the moments with a lot of growth. Right. Now, I don't want to grow and stress myself out and get depressed and stuff, but growing in a healthy way. And so bring this together to play the long game. I'm 29 years old right now. I love the quote, people overestimate what they can do in 1 year and underestimate what they can do in a decade. 100%. Any person listening to the show, you could be a billionaire within 6 to 8 years. Wow. I mean, look at all the billionaires right now that just have minted new billionaires. Most of them were nobodies 7, 8 years ago. Yeah. All of us have a chance in 7 or 8 years to be a billionaire in terms of, and there's a lot of different ways you can define success. We'll just define monetary success for now. Right. So I'm 30 in June. I'm like, okay, let's call it a decade at a time. I have till I'm 40. That's 1 decade. 50, 60, 70, 80. I look at Warren Buffett. He's 94 right now, 93. 99% of his wealth was generated after he turned 65.
Yeah, I saw that.
I mean, we have a lot of time.
Yeah.
And so can we play the long game? Can we make good relationships? Can we treat investors right? Can we play, and over a lifetime, what can you accomplish and achieve? And not just, I'm talking financial success. What can you do with a family? What can you do with your body, with your mental frame and state? What can you do? And if you can treat people right and play this long game, I think it'll serve you really well. So I went from a full shift, to wrap this whole segment, a full shift of get rich quick, try things really fast, try that little hack, that side hustle, to now, what's the purpose of my life? And this is my life work.
Right.
And I'm going to find joy and extreme satisfaction in the work.
Yeah, absolutely. That's a really important thing, because you can sustain that work when you have that why behind it for decades, and that's where it compounds, and then that's where the real wealth is generated, obviously. So thanks for breaking that down. Now, with respects to you mentioned a few things, right? You mentioned private equity, and then you said, people look at whether it be VC or whether it be hedge funds and things of that nature. Can you distinguish private equity specifically to clarify that for the audience who may not have a background and understand those different terms?
Yeah. So what do all these terms mean? In a basic sense. So what is a fund? The most basic, so all a fund is a pool of money. Investors put money into that pool. And then me and you as fund managers draw from that pool and go and make investments. Whenever those investments make money, we just split the returns. This is one of the oldest business models on earth. It was like, hey, we're going to go open a blacksmith shop. Can you guys put money in? And then when we make money, we'll just split the returns. Christopher Columbus, we're going to go to the New World. We're going to find some gold. When we come back, we'll just split the returns, but you got to pay for the boats. You know what I mean? Like it's not anything new. This is like one of the original business models of all time, So all it is a pool of money, right? You're just pooling money together to go buy assets. And now, so what's the difference of a real estate fund, a hedge fund, a private equity fund, a private credit fund? Like, what do those terms mean? The only difference, and we've helped launch every one of those funds I just mentioned. The only difference is the type of assets they purchase or type of things they buy. So we'll start simple. What is a real estate fund? It's a pool of money that buys real estate. Ta-da, like pretty simple. So the next one, what's a private equity fund? A private equity fund is a pool of money. Instead of buying real estate, they buy private equity, which is private ownership in private businesses. So they go buy private businesses. So there's a big firm on Wall Street called Sycamore Partners. Sycamore Partners owns Staples. They own Nine West Shoes. They own Aeropostale. Last year, they were trying to buy Kohl's department store. Okay, that's a private equity firm. They buy private businesses. So what's a hedge fund? A hedge fund is, again, a pool of money. Instead of buying real estate or private businesses, they buy public businesses. So they buy stocks, bonds, options, futures, crypto, Forex. You've heard of those terms? That would all be in the hedge fund. They're all structured about the same, though. Okay, they're not that different. I've built all of these funds. They're pretty much the same. There's little nuances, but they're pretty much the same. I'll share one more. The venture capital. What's a venture capital fund? It's a pool of money. Instead of buying those other things, they invest into early stage startups. So it's a pool of money. They invest into 20 to 30 early stage startups, and they hope some of them take off. And whenever they take off, they return the money back to investors. So it's really the one things I hate about high finance is they make all these technical terms of really simple things. It's not that complex. When you get in and start learning it, you're like, oh, this isn't that hard. This is very relatively simple. Any normal person can understand these kind of things. Is that helpful?
That is super helpful. One last question about that, because I personally have been in companies and startups and things that we got investment from family offices. Could you break down the family office aspect as well as that's the last one to kind of mention before we move on?
Yeah, a family office is a pool of money, but it's only one family's pool of money, or maybe a couple families' pool of money. And then they make investments. And whenever those investments, and they do a broad range of things. And then whenever those investments make money, it just goes back to the family. Now, so I'll unpack a family office a little bit further, though. So why even have a family? Like, all of us run family offices ourselves. I have the, even if you're broke, you run the family office of just, broke Bridger. Like back when I was 21, mentally, I'm like, I have a family. Like, I'm running my own family's money, right? I run my own credit card bills, my own bank statements. There's a moment when you make enough money that you start hiring people to do this for you. And just for you. So currently I'm setting up my own family office right now. So I've hired now they're fractional. I have my own accountant, my own tax person, and my own wealth advisor that vet because I get so many investment opportunities. I go, hey, just send it to my wealth advisor guy. He can vet it, and then he'll bring it to me for final decision. And I work with currently what's called a multifamily office. So there's about 30 families in this one company. We all work together. We all share a lawyer. We all share, a CFO. We all share a tax person and an investment guy together. That would be a multi-family office in one. And then once you get big enough, you are now paying all those people yourself. So usually you're, let's call it, you're a $200 million family. You hire a full-time CFO. You hire a full-time tax person, a full-time accountant, a full-time asset manager, and you pay them a salary. And so you're paying $800,000 a year probably across those salaries for people to just manage your portfolio of, and I mentioned $200 million because you need to have enough capital where it makes sense to pay those salaries. Right. So then you would probably crown yourself like, oh, this is a family office. This is an office that just manages my family's money. So kind of a loose term, but that's once you get to the point where you are, hiring full-time people to run your own family's money, that would be called a family office. And like I mentioned before, the downgrade of that would be a multi-family office. Like I'm in that. There's probably 50 families together. We all share resources together. We share those bills together, but we all are in one. And then below that would just be like an individual. Like you're a high net worth individual. You've made some money and you're, managing it kind of on your own. You have a fractional guy that helps you in certain areas. Does that make sense?
That makes perfect sense. And then with the multifamily offices, do they typically have different thesis for each family investment thesis, or is it the case that sometimes they're all investing in the same thesis? They just are different families doing that. Good
question. Every multifamily office runs a little differently.
Okay.
So some will have more centralized thesis. They all pool together. Sometimes it's the one I'm in, very separated. Every family has a different mandate. Every family has different goals. Every family has different stages of life. So they, but what they'll do, so like my multifamily office, if I have a good deal that comes across my desk and I send it to them and they review it and then I look at it like, I'm not going to do it. They might take that deal and take it to the other families as well. Hey, do you guys want to get on this? And vice versa. Like they just came to me last week. They're like, hey, we have shares in Starlink. Starlink's trying to buy. One of our other families brought it to us. They're trying to raise more money. Do you guys want to put money in this?
Right.
I passed on the deal, but I was like, great. Mr. Beast was trying to raise money a few months ago. We got it passed through our family office, multifamily office, and all the families got to look at it. People could decide if they wanted to invest in Mr. Beast. He had a round they raised. I don't know, it was like $100 million or something. We passed on that one as well, but that would be the idea of around a multifamily office.
Yeah. Is that the TikTok deal that they were looking at doing when China was getting shut out, or is that something you can't mention?
Well, the one I looked at was a different one. They were trying to raise at like a $7.5-8 billion valuation for, I think, just studio. Like they needed to pay for more studios, more videos, stuff like that. I believe they closed the raise. There was a different application to buy TikTok. I don't think that materialized, at least to my knowledge.
Yeah, no, not yet. I just happened to be associated with a couple people who were really trying to, initially get that deal going and things. So I was hearing about it. Awesome. Okay, now.
Can I add one thing to this though?
Shoot.
Back to this whole thing though. So I heard about family offices, I don't know, let's call it 10 years ago. I was like, wow, that's so cool. And so I was like, okay, I'm going to run my life like a family office. And this is when I had like $7,000 to my name. Yeah. And I was like, okay, I'm going to run it like a family office. So I did a monthly meeting with myself. And I still do this to this day. I have a spreadsheet. Every month. I track, and I just wanted to see, where is it at? I track every credit card I own, every statement, every investment I've made, every bank account I own. And I put it on a spreadsheet and I track, where is it at? Where am I moving my money? What is, high leverage activity? What's hurting me here? And I track all of it. I still do it to this day. I do it with my wife. We do it once a month. She hates doing it. And I make her do it. I'm like, hey, you need to know where all of our money is at. Right. If I die tomorrow, you got to know where all these accounts are and all the investments and everything. And so we go through it, we track it, and there's an old saying, whatever you measure grows. Right. And so I was like, I'm going to start measuring money. I want to master the game of money. I did this when I was like 21 years old, 22 years old. I sat down with myself every month, went through, okay, where am I at? Where am I allocating dollars? And I would do percentages. Okay, so how much of my percentage weighted towards crypto or stocks or real estate? And what can I do? And what's my tax bill? And what's my, even though I was small, I wanted to practice when I was small so that one day when I got rich, because I'm going to be really rich one day, I got to learn this now that I could do it when I was rich as well. And so I'm in the middle of that game. I'm on the path from being poor to rich, Yeah. But I'm trying to figure that out right now. But I thought it was a really good practice that served me extremely well, and it still serves me today.
Yeah, that's solid wisdom. As they say, what you do with a little is what you'll do with a lot, right?
Exactly.
And so if you don't get those fundamentals down, then you're probably going to have things come in unravel when you get a lot of money and or get a lot of opportunity. Now, so this brings me to a specific point. What would you say are a lot of misconceptions that people think about funds in general? Like, and I'm talking like regular people who've never been involved with it, haven't been invested in by a fund, but they're interested in learning about it. They know about it, and they think they have a vehicle that's scalable to the moon.
Conception number one, it's too complex. I can't figure it out.
Yeah, for sure.
Yes, it's hard, but it's totally doable. It's not that complex. You can, like, people can do this. You can figure it out. Number two, it's only reserved for the Ivy League elite. Also a huge misconception. So, and both those we've proven wrong like over and over and over again. There are normal people doing this every day. You can understand this game. It's not that complex. And number two, it's not just reserved for people with, that grew up and went to an Ivy League school. Regular people can figure out this game and do it.
Yeah, absolutely. Those are really good things to point out. Being someone that's early, I wouldn't say you're early in your career because, I mean, you've already got 8-9 years under your belt now. But let's say someone who's earlier than you and they're getting their first funds going, but they don't necessarily have a specific investment vehicle that they're familiar with. Is there a space for someone, for example, who's like a good deal finder? If you're good at talking to people, if you're good at getting in front of sellers of real estate, for example, and you can get them to sell at a price lower than the market, that's a skill that you can develop deal flow that you can launch into a fund. But let's say it's someone who they're trying to figure out what to do to get involved. What would you say from step one? What would you recommend for someone who wants to get involved in private equity and one day launch their fund or invest or whatever the case may be?
Well, step one is educate yourself on the space, just because you don't know what you don't know. It's like the unknowns of the unknowns. Like, I don't even know where to start because I don't even know what the starting point is, right? So we have tons of free content online we put out all around funds. So I would just go check out. There's tons of free stuff. Just go learn the game.
Right.
And then if you're more serious, you can go from there. You mentioned as well different skill sets. For me, for example, and you mentioned, you can say I'm young in my career. You can say I'm old in my career. I wanted to get in early and started building a track record. I've been a fund manager now for 7.5 years. I currently manage about $45 million of capital raised, which we believe will give us an AUM of around $100 to $150 million here in the near future. So am I young? Am I old? I don't know, but I've been in the game for, let's call it 7 years, managing other people's money.
Right.
I am not a expert investor. I don't claim to be. I'm not this world-class investor. What I like to do is go find world-class investors and partner with them. So we run a crypto investment fund. I'm an okay crypto investor. I like crypto. I watch the Twitter feed and crypto's cool. Let's buy some. I found a partner, my partner, Dan Young. Dan had the largest crypto mining facility in the state of Utah in 2014. Huge warehouse. So it was like a decade ago. I mean, he was early in crypto. He's been on the board of Intel for 16 years. Wow. Board of AMD. I mean, this guy's done hundreds of millions in sales. Yeah. Very, very good crypto investor. He was getting his first Bitcoins at $100 to $150. They mined tons of crypto. They then and Dogecoin, they ran up to 17,000, sold a lot. He bought a ton of commercial real estate in 2017. Then he rolled back into crypto. He's done extremely well. But he's like, I don't know how to run a fund. I'm like, I know how to run a fund. Let's do it. And so I know how to run the fund mechanics. I do all the compliance, all the back office. He runs all the crypto stuff. And then together we go raise capital together. And there's three main buckets for every fund. There's what I call the expert investor. The second bucket would be the fund manager, and the third bucket would be the capital raiser. Okay. Now that can be 2 people, it could be 20 people, but all 3 of those roles need to be filled. And so I would find a role that suits you well and get into that. Typically, no one really does this alone, right? Find something you get really good at, and then partner with other people that fill the gap. So if you're not good at raising money, that's okay. Find someone who is. Right. If you're like, well, I need a Harvard degree. Harvard graduates, I don't know, 1,000 people a year, 2,000 people a year. They're all looking for jobs. Go find one of them. You know what I mean? And it's funny, people don't think that way, but it's like, no, really though. A lot of them want to go work in investment funds. They really do. That's the jobs they are looking for. You find people from Stanford or Yale or Wharton, they're looking to work in the fund management space. And if you know how funds run and how they work, and they can bring a network and partner with you, it's an interesting game. It's a different way of thinking about entrepreneurship. Yeah. And playing the game.
Yeah, that's a good point. And this has been made on the podcast before, where it's, as a founder, the right mentality, which is hard to get to, is not necessarily going and getting sales done and not those minute details in your business. But really, the whole idea is you want to find the most talented people possible and get them to work for you. And whether that be being able to fundraise a lot or have this this unicorn of an opportunity. That's really what your job is as a founder, the CEO. And I guess now as a fund manager as well, your job is to find the most talented people at fundraising, managing funds, investment opportunity analysis, and things of that nature. Is that on point with your point there?
Yes. Well, yeah, very on point. Well, and that's a great way to frame it. And then the follow-up question is then, well, how did you do that? Then how do I go find people? And no one wants to partner with me because it's a very scary feeling. The feeling of a CEO is this: you have found the smartest people you know, and you've hired them, right? These are the best people you know. You've hired them, you brought them on your team, and when they can't solve a problem, they bring it to you to solve the problem.
Right.
It's a scary spot to be in. You're like, man, and those are the problems you deal with every day as being a CEO.
Right. And
so then the natural question is, how do I find great people and partner with great people and bring them around me? And the analogy I always use in this is it's kind of like dating. Okay. What is the easiest way to date a 9 or a 10 on the scale? Now, the easiest way to date a 9 or a 10 is to just be a 9 or a 10. I know sometimes there's a 6 and they date a 10 and we make movies about it and write books because it's so awesome and crazy, like Adam Sandler goes and dates this awesome chick and you know what I mean? But generally speaking, the easiest way to date an 8 is to also be an 8.
Yeah, for sure.
You know what I mean? And so I think the same thing's true with business, right? If someone's a level, on a scale of 1 to 10, a level 9 entrepreneur, they want to do business with other level 9s or level 10s. And so if you're level 3 and you're like, hey, can I do business with you? It's like, no.
Right.
I don't, why would I do business with you? And it's maybe a tough pill to swallow. So I look back at my partner, Dan. So why did he partner with me? At the time I was 27 years old. He was 50 years old. He's done hundreds of millions of dollars in sales, been on the board of Intel for 16 years. I have 8, 9, 10 entrepreneur, a very good entrepreneur. Why did he partner with me? Maybe I just got lucky. Maybe I'm one of those, I'm like a 5 dating a 10, maybe.
Right.
But also I knew a lot of stuff that he didn't know about funds. I was very, very good at one sector of business that he had no clue about.
Right.
I was very, very good at fund management. And you see this as well with young, kids that are really good at coding. They'll go partner with these awesome entrepreneurs because they know something about a very specific niche that the other person, they need them. Well, we need this guy. He's really good at coding whatever software. We need him, or whatever little niche. So can you sharpen the axe in a certain area to this? I'll share actually a true story that happened with me to emphasize this point. So I got invited. I was in my mid-20s. I can't remember the exact age. I got invited to go to this meeting. And this guy, Mike, invited me. I went to go. 2 other guys were there. They were wanting to launch about $100 to $200 million fund. These guys are all twice my age. I'm in my 20s. They're all in their 40s or 50s. Very successful entrepreneurs. And these guys all drive, sports cars. They have private jets. I mean, these are very successful entrepreneurs. I show up. It was pretty obvious in the first 3 minutes. We, meaning them 3, are going to do a fund. Bridger is not included. Us 3 are going to do this fund. Bridger, I don't even know why you invited Bridger to this meeting. It was blatantly obvious. And I was like, It makes sense. I'm like, young, why would they invite me? And so I'm just sitting there and they're talking about their fund that they're going to launch. So I'm just sitting there, in this nice boardroom, we're just talking. And I have this moment of courage and I'm like, screw it. I'm going to try something here. And so I raise my hand. I'm like, hey, real quick, as you guys are going on, do you guys plan on running an American or European waterfall? Are you guys going to do a 3C1, 3C5, or 3C7 fund? Are you going to do a Reg D 506B, 506C? You're going to do a Reg A plus fund, Reg CF fund? What kind of stuff are you guys going to do for your fund? And they all went quiet. And they're like, go up to the whiteboard. Tell us what do you mean? What's a European or American waterfall? I was like, oh, you guys don't know this? And I went up to the whiteboard. I started to explain to them what's an American versus European waterfall. What's a pref, catch-up, carried interest, 3C1, 3C5, all these technical terms for funds that are relatively simple, by the way. If you learned them, you could learn them in an hour or 2.
Right.
They're not that hard, but they didn't know them.
Yeah.
In about 7 minutes, my clout in the room went from 0, dirt, lower than dirt, to they wanted me to be an equal partner in their fund with them.
Wow.
A 25% owner, 25, 25, 25.
Right.
Because I knew something. I was a level 10 in an area category that they had no clue about.
Right.
And I was able to show that expertise to them. They wanted to partner with me. And anyways, I left that meeting. That fund never actually launched. Those partners, they were all fighting and ended up not launching. But the point remained true. They wanted me to be an equal partner with them. in that opportunity. And so back to, they always say it's not the how, it's the who, right? The who is important, and there's a lot of introspection. If you're sitting there, and I do this a lot, like, how do I increase my who? Well, I need to become a better who. I need to become a person of value that they want to partner with and talk to. And I do this all the time. If I called up Elon Musk right now, he wouldn't partner with me. I provide nothing to that guy. But maybe in 10 years, maybe in 10 years I could partner, or Jeff Bezos, or whatever person, put X person on the map. Can I sharpen and be, they're like a level 100. Could I be to that level?
Right. That's such a good way to break it down. And so you mentioned the 3 different roles in the fund typically, and this could be an entire department or one individual fundraising or whatever the case may be. Could we talk about 1 or 2 of those roles, and in that specific role, what the core skill sets that people could become really good at, become a level 10 so they can interface with these other level 10s and then come together and knock things out of the park?
Yeah, the 3 roles again are what I call them: expert investor, fund manager, and capital raiser. Again, 1 person or 20 person can do that, but it's the role that's like hand. So the first one, expert investor. This person is really, really good at investing or buying whatever. They've traded options in their basement for 20 years and they're just crazy at it. Or they've done real estate for the last 8 years and they're just so good at looking at real estate. Generally speaking, though, that person has no clue how to run a fund. And a lot of times they have no clue how to raise capital. They're just really, really good at they're really, really good at running HVAC companies. Like, they're just good at it. They just know how to do HVAC companies, but they have no clue how to scale that or buy or run a fund or anything else, right? So the next tier, fund manager, that's what I'm really good at. How to structure a fund. What's the compliance? What's the mechanics of the fund? That's internal audit, accounting, legal, compliance, all that kind of stuff to actually function or run a fund. That's what I'm very good at. That's what we teach on a lot of our courses. We teach a lot about that. The final one is capital raising. There are people out there. There's a guy that called me up this is like 3 years ago. He's like, Bridger, hey, he's a guy, he goes to every networking event. He goes to every chair. One of those people that they just always are at everything. They're just natural, born salespeople. They're just, you know what I mean? Like, those people that are just good at. This is this guy. He calls me up. He's like, Bridger, I have 2 billionaires that just love me to death. We're like best friends. They want to invest in one of my deals, not like somebody else's, but like something that's mine. Bridger, do you think I could partner with you and be a part of your fund? And I was like, you got 2 billionaires that want to put money in? He's like, yeah. And I'm like, saddle up, partner. Let's do it. Let's go.
Yeah.
So there are people that are natural born salespeople that just, they've done it for a decade, right? They've gone to they just know people. And so different skill sets, right? You bring those people together. Does that help answer that question?
That does. And one thing to iterate on that conversation, a lot in the real estate space, right? Like you mentioned Pace Morby. One of the biggest things in the sub 2 group, which I'm a part of, is squat up, right? Like, find someone who can bring private capital, either find a deal or find someone like a wholesaler who can find really good deals, and then find someone who's an operator who can actually operate it. So after we take it down, it's not a problem now. Is there a space in the fund world where you could be that person who puts all these together, even though you're not an expert at deal finding, you're not an expert at fund management, you're not an expert on the operations of a fund and things of that nature? Is there a world where that makes sense to start doing that and to get your toes wet while you build that networking skill set or whatever the case may be?
That's a skill in itself, right? I would call that under the fund management bucket. I would still show expertise in one of those areas a little bit, but then you're asking for help and bringing people together. But 100%, yeah. Now, again, why would those people want to partner with you though? Because you would show some type of expertise in an area that would help them. It's always mutual. It's always got to be mutual, right?
Right.
Otherwise, they'll just say, oh, we don't need Bridger anymore. Kick him out and we'll all just do it together. So you've got to show that value in some way. And it could be any of those categories.
Yeah, for sure. And then getting the trust to get someone to work with you. And I know you said, you want to become that level 10 person, but as we say, business moves at the speed of trust. How do you, as a young investor, and previously when you didn't have that experience, how do you build trust and network and things of that nature? Do you have any recommendation, whether it be frameworks, books, anything of that nature there?
Well, I'll say this. It's not, you don't do it overnight.
Right.
It's a hard answer, but it's a lifetime.
Yeah.
That's the true answer. Why would you trust somebody? Because they've shown a pattern over a lifetime of someone who I can trust.
Right. And then,
so, speed to trust now, how do you demonstrate that? I think it's by showing excellence and in all areas of life.
Right.
And the level of standards that you live yourself by. A standard that I hold I'm getting more granular for investments that I make. if I'm going to invest in your thing, you have to have third-party audits done every year.
Okay.
You have to have a third-party administrator on your fund. If you don't know what those two terms mean, I'm not investing.
Right.
So we pay every year, we pay tens of thousands of dollars to outside firms to come and audit us. We bring it, people hate audits, right? We invite them to come audit us every year to prove that we're honest, right? Like that's what we do for our funds.
Right.
That's one way to build, trust in something.
Yeah, absolutely.
Who you are and how you demonstrate the products you push, the way you run your business, your company, how you hold yourself, how you hold your family. It's not a, there's no magic wand, right? It is who you are, right?
Yeah.
Down to the core. And I'm a big believer when looking at others, and I think people do this same with myself. I like to date partners before I get married. Just like, we're going to date for a little bit. Let's date things out. Let's see how we work together. Let's see, is there negative things that come up? Do you have a bad reputation? It's funny in such a world that's on social media and online. I had a great mentor tell me this. He goes, you'd be surprised how quickly word of mouth spreads.
Yeah.
And I was like, huh. And he goes, don't just think word of mouth spreads faster actually today than ever. What is the brand you have around you? What do people say behind your back? And what would influence that for good or bad?
Right.
It's not a simple answer. I don't know. What would you say that to David?
Yeah. Well, as you said, transparency is a big thing, right? Personally, what I like to do is lead with competency. So that goes to your point of becoming a level 10. That's the thing. Like when you can come with some form of competency that you're better at than whoever you're talking to, then that's like one of the fastest ways to get to trust, right? When they see that. One thing I do have question that I want to ask you about when you're launching things, you mentioned like a special purpose vehicle, right? It's something that some people can utilize before they launch a full fund. Would that be something that you could use in this phase where like what you did, you raised, tens of thousands of dollars for your first deal? Do you feel like that's a way to start building that trust and build that track record initially? Or do you think you still need to go and you still need to you need to cut your teeth doing sales, or whether it be fundraising?
No, 100%. We're actually launching a new product in the next few weeks called what's called a single asset fund. So some people call it syndication, special purpose vehicle. The technical term is actually single asset fund.
Okay.
You're doing one asset, so you're buying one property and you're pooling money together for that one business or one property. That is I tell most people that is the best way to build a track record.
Right.
You mentioned earlier, it's biblical, right? If you're a good steward over one, a small amount, you'll be given more and be a steward over great things. So can you show and can you demonstrate being good, number one, with your own money? Are you a good money manager of just your own money, your own family office, like we mentioned earlier? Second, are you a good manager of maybe a small group? And that would be a single asset fund. You're doing one deal. Maybe you raised a few $100,000 from family and friends. How did that go? Right. Okay, great. That went well. Now let's try to do multiple assets at the same time. We're going to buy 3 or 4 deals together in more of a bigger fund. That would be the progression that most people go on to build that trust. And people go, oh man, David, yeah, it looks like he did really good with his own money. Then he did good with other people's, a little bit of money. And now he's doing good with like a bigger group of money. Yeah, I'm going to give that guy money. Because he's demonstrated over a few years that he's a good manager of capital. And he's got audits. He's got third-party administration to prove that those numbers are accurate and what he's telling me is correct.
Right. Okay, so that transparency, also getting the reps and showing that you can do those successfully, that's another way to build that trust initially. But one other thing I want to ask about risk, right? So a lot of people here, I know that that's what's screaming in the back of their head. We don't know what direction the economy is going to go in. I mean, we can guess, but we really don't know. How do you, with fund launch and with your personal experience, how do you look at risk, and how would you expect, or how would you suggest people who are considering launching a fund to look at that, who are early in their days doing it?
Yeah, we run everyone through a framework. We call it our risk control matrix.
Okay.
There's 2 types of risks. There's risks you can control, and there's risks you can't control. Both are important. And so what we like to do, let's take HVAC. You mentioned this earlier, an HVAC company. Okay, so what are risks that you can control in that company? Well, I can control my payroll, my overhead, how much I'm going to pay drivers, my marketing. There's a lot of things that I can control, right? So I'm going to put on all things I can control. Now, what can I not control? War, like a tariff, economic war. I can't, maybe a lot of my, interest rates from the Federal Reserve, stuff like that. So I write all these things down. So we write them all down on a list. Then what we do next is we say, how sensitive are we to those risks? And we'll isolate one at a time. So let me go broad, just so this will apply to everybody. So if interest rates go up 1 percentage point, I'm going to run a little financial model on my Excel sheet of, hey, what does that do to my returns? Are they very, does it kill my business, or is it just kind of the same?
Right.
How sensitive is, and if rates dropped a full percentage point, does that make my business thrive? Or is it just kind of the same as well? And then I'll isolate that. I'll see what's my base case, best case, and worst case scenario, isolating that variable, all things being equal. And then I'll go back to, okay, so what if a risk that I can control? What if, I can't hire anybody? Like everyone quits, right? My competitor comes and hires everybody, right?
Right.
I can control that, but it's a risk, right?
Right.
How would that affect my sensitive that I am to that as a base, best, and worst case scenario? For like a real estate fund, what if rent roll, rents go down or rents go up? Or what if vacancies, right? How sensitive am I to those changes? So we talk a lot about risk. You can't, most of the time you can't eliminate risk, you just mitigate risk. And so how do I mitigate risk in this offering? And so what I do is I run through this whole matrix of how sensitive am I to all these risks. I then boil it down to, okay, we've got an investment opportunity here. We're going to go buy 10 HVAC companies. Number one, actually be honest with yourself. Right. You might run through that and go, crap, there's not a lot of ways we can win in this. Like this actually isn't that good of a deal. Yeah, there's one chance we could win it, but like it's not in our favor. Maybe let's wait for the next deal, right?
Right.
Now, you might boil it down, though, and say, no, we've got a lot of alpha or asymmetrical risk here. Let me describe what that means for a second. This is what we are searching for from that whole model. As a fund manager, you're trying to find asymmetrical risk, which is a financial term. It's pretty simple. You've probably heard of high risk, high reward, low risk, low reward, right? Asymmetrical risk is when you can find something with relatively low risk for high reward. That's what's called asymmetrical risk reward. Right. Now, some people say, well, that's impossible. I was with Ray Dalio just a few months ago, one of the best hedge fund managers of all time. He goes, that's what we do 24/7. We were at the Greenwich Economic Forum together. He's like, we found that if we find 10 to 15 uncorrelated assets and put them in a pool together, diversification alone, we can mitigate our risk by 80% while keeping our return the same. This is what fund managers look for. They call it alpha or asymmetrical risk. You are trying to find things that have relatively low risk for the return. Let me give you a more practical example. A house flipper, okay? I have a buddy, he's flipped 300 houses. He's a phenomenal house flipper. The average house flip makes about, in America, makes about $65,000. I would guess his average house flip makes like 70, 80, 90,000, okay? When he flips a house, there's relatively low risk because he's done it so many times. He just knows the market inside and out. Right. If I go flip a house, people always make fun of me. Like my family makes fun of me. I'm not very handy. I'm just not a handy guy. Like I'm just not good. I'll just hire somebody else to go. My brother's like building shelves in his garage. He's building the deck outside. One of those people. That's my brother. Me, I'm a liability, if I'm trying to build my own deck, I'm just going to go hire a guy. I'll just go hire somebody and I'm not going to do it. So anyways, if Bridger tried to flip a house, a lot more risk. If my buddy Mike tries to flip a house, very low risk, right? Another example I'd give, maybe me and David, if we're in business together and let's say, some investors looking at it, we have medium risk, medium return. And let's say we introduce a third business partner and our third business partner is Jeff Bezos. If you're an outside investor looking at this, you'd say, is it more risky now or less risky? Probably less risky. He's got tons of money, can overcount. He has all the connections in the world. Jeff Bezos, probably going to minimize some risk. What's our chance of return? Down or up? Probably up, like crazy. Right, Jeff Bezos getting involved, like one of the greatest entrepreneurs to ever live. So just by introducing a third business partner, you can create asymmetrical risk in a deal. Long answer to a short question, but we look a lot at risk. Okay. Really be honest with yourself. What do I really have asymmetrical risk? Do I have relatively low risk for high return? Would I bet my grandma's money on this thing? You got to be that confident. I love my grandma. Would I bet her life savings on this? Yes. That's how confident you got to be when you go out. You can't just kind of be like, oh, I hope it works. Right. You can't do that. It's got to be so solid. This is a lock. Yeah, there's a chance it fails, but man, I'm putting my own money in. I'm putting everybody I know money's in because this thing is phenomenal.
Right.
It's going to, like, we really truly believe the numbers are telling us, like, everything is telling us this thing is going to, rocket ship.
Right.
That's how you got to approach it.
Got it. And are you locking the investors in for 10 years in your fund, or what does that look like typically? Time frame.
Every fund is different. You can determine what you want to do. One of my funds, of Unicorn, it's an open-ended fund. Investors can come in and out. So they can join every month. After 1 year with us, they can give us a notice and leave the fund anytime they want.
Okay.
Our other fund, Fund Launch Partners, they're locked in. I believe depends on, it's a close-ended fund. We determine when we pay the capital back. We're planning on having it for about 7 years.
Okay.
So one fund is 1 year, another fund 7 years. Some funds are 3 years. It just depends on the fund, what you want to do.
Okay. And the reason why I'm asking that question is because you mentioned Ray Dalio, and I think about some things where he talks about short-term credit cycle, basically, versus long. But basically, when we see these interest rates changing and things of that nature, we kind of have an idea of what at least real estate and the economy is going to do in America over 10 years. Are those the type of things that we look for where we know every 10 years that the property value is going to become higher in America? Are those the type of things we look for where we say this mitigates our risk because we know, typically speaking or historically for the last 7 decades, we'll get returns this way, and that's the benefit of being able to lock them in long term? Or kind of how does that apply to what you're doing?
So generally speaking, you have a business cycle. It's usually 7 to 10 years. Ray Dalio talks about the debt cycle, short-term debt cycle, long-term debt cycle. So yes, you factor that into your investment thesis or strategy. It's one of the risks and returns that you look at. Moreover, though, some things take time. We're trying to return capital as fast as we can.
Okay.
I'm trying to, it's not like I want it to be 7 years. I would love it to be 2 years or 6 months. I'd love it to be 30 days if I could.
Right.
But if I'm investing into business, sometimes it just takes time to buy a 300 unit apartment complex, to put in new pools, to lease it up, to then sell it. It just takes time to do all that. And so it's generally, so it's going to take 3 or 4 years for us to buy this property, stabilize it, get rents up. Some things just take time to happen.
Right.
Other funds do really play a market cycle. So I'm in a crypto fund. We play a market cycle. We believe crypto goes in 4-year cycles. We're entering the last year of that cycle right now. So we play a longer game. We want to run this fund over multiple cycles. So it just depends on the fund and fund thesis.
That makes sense. And so by doing this day in and day out, you're getting to see a lot of deal flow in a lot of different types of funds and what's basically happening real life in the market. What would you say is your top 2 or 3 hot items that are on the top of your mind, and this is something that you would recommend people at least look into if you're getting started?
You're talking business types or investment types, or just things that are going on in the world?
Yeah, I would say investment types, like whether it be crypto, whether it be AI, whether it be real estate. Like we have a lot of these companies that are vibe coding, and nowadays you can go from 0 to 10 million ARR in a matter of 6 months, right? And we're seeing that actually happen. I'm thinking those type vehicles. What would you say are the exciting things that you're seeing in the future that people could invest in and start learning about so they can become the person that people invest in?
A few that I'm excited about. I'm in crypto. I mentioned crypto. I'm in crypto. I've been crypto since 2017. We ran our fund since 2022. Today we're filming. It's April 24th. Prices are relatively low right now. We're entering this last year of a 4-year cycle. If you study crypto, we had the 2013 cycle, 2017 cycle, 2021 cycle. We believe we're queuing up for a 2025 cycle.
Okay.
We have sovereign wealth funds, countries right now all considering buying crypto and Bitcoin and adding this. Terraform has added a significant amount of waves throughout the macro economy. And I think a lot of people are turning to blockchain. We have the most crypto pro government the world has ever seen right now.
Right.
From Senate and Congress and the Trump administration. Everything is queued to be a phenomenal next bit for crypto. We're very excited in the cryptocurrency space. Furthermore, a couple other things that are exciting. You mentioned AI, vibe coding. We are hitting a point right now in AI. It's funny, 2 years ago, me and my business partner sat down. We're like, we should build a tech product because we had all this big community and stuff. And we're like, it was going to cost us $1 million and a half dollars and probably 6 to 12 months to build. We've hired 2 people here. It's cost us about 15 to 20 grand. We've built that whole thing in about 6 weeks. We just barely started doing it because of the advances in AI with building out product. It's just getting better. As an entrepreneur right now, I am sitting here like we are hitting a cusp where it's becoming very useful for us to truly build businesses behind using, things like Cursor. If you look up lovable AI agents right now, Google just dropped AI agents that are very useful. There are some very, very interesting, and I'm not talking to ChatGPT. That's fine. You can chat with it, but there's very use cases. Cursor is the dominant one right now. It's taking a team of 20 devs and turning them into, one or two devs are doing the same output as 20 or 30 devs were doing 3 years ago. It is wildly interesting. If you're an entrepreneur, I would definitely look into that. Furthermore, there's a fantastic book. My dad has read this book, I think 3 or 4 times. He's like, you got to read this book. I'm like, okay. It's called The Future is Faster Than You Think. Now, this book came out in 2020, I believe. Still very relevant book as of today. And they've predicted most things right so far. These guys are in Silicon Valley. They wrote this book. They talk about this concept. I want to give them tons of credit because it's a phenomenal book. They are talking about something that we've never seen in history before that is happening right now. They call it the convergence of technology.
Right.
So in the past, we had one new technology come out at a time, right? We had the internet come out. We had automobiles come out, and it was this huge emerging technology. And then the question is, well, why don't we have flying cars?
Right.
Like we were promised flying cars back in like the 70s. Like by the 20s, we're going to have flying cars. Why don't we have flying cars?
Right.
Well, the answer is it's kind of complex. To have a flying car, you have to have, high-speed computers. You got to have really good robotics. You also have to have high-speed internet to be able to transact and transmission data that quickly, just to name a few. And they mentioned what we're seeing in the 2020s is we're not seeing the emergence of one technology. We're seeing the emergence of about 10 technologies all at the same time. And they're converging together.
Right.
And they're helping one another. So you mentioned AI, that's one. The emergence of AI is huge, right? It's going to be world-changing. We're also seeing the emergence of blockchain. I mentioned crypto. Crypto and blockchain is a world-changing technology.
Right.
We are also seeing the emergence of robotics at a huge degree. We're seeing the emergence of 5G and 6G internet, very quick transactions of data transfer around the world. We're also seeing the emergence of quantum computing. We're seeing the emergence of 3D printing. So I'm just naming out, they go through 10 of these, and they are all converging together right now.
Right.
So we're seeing AI help quantum computing, which is helping transaction speed for robotics, which is helping blockchain, and we're mixing them together. And so when you talk about a curve on Moore's law of how quickly things can develop, we are hitting a ramp phase right now. Some people call, it depends on the month. People are, we're loving AI, we're loving quantum computer. We're seeing all of them emerge at the same time. There's about 100 companies right now working on flying cars, essentially drone cars right now. There's hundreds of companies obviously working on AI, 3D printing. They're doing 3D woven clothing right now. So you would send in your dimensions. They have bodysuits you wear. They're currently, they predicted this in this book, and now they're currently out right now. You wear a bodysuit, it gets your exact dimensions. They send the dimensions in to a factory, and they 3D, it's not like a print, but they weave it. It's a 3D weave. They weave your exact dimensions for a shirt or a dress or whatever to your exact specification. So we're seeing, quite an emergence of technology, and I think there's a lot of money to be made in these emergence technologies. So I would try to skate, I'm trying to skate where the puck is going, not where the puck has been. There's a lot of people doing wholesaling. There's a lot of people doing seller finance. There's a lot of people, which are fine vehicles. They may become very obsolete here in the near future as we are moving very quickly. So I want to, at least what I'm trying to do is skate where the puck is going, not where the puck has been.
Yeah, no, good, very good.
So those are things I'm excited about. I don't know. We can add on more, but I'm pretty hyped about where we're headed right now.
Yeah, because what we're seeing basically is, like you mentioned, the democratization of this, right? Where what's democratizing right now is the ability to be an entrepreneur, create a business, create a software product, or whatever the case may be that you're utilizing to bring value. And so one of the things that you'll see is there's just way more people in the market now creating SaaS companies, AI agents, and things of that nature. Now, are you seeing a similar thing happen where there's a boom of people getting involved in funds as well? Like we're seeing, I would say, more downstream, we're seeing more businesses being launched, more products being made, more software companies coming out. Is that similarly happening in the fund space?
100%. We've seen a major uptick in funds filed and funds created.
Okay.
I want to say we've been a part of that. We've helped move that needle, and just around the globe too. We've seen a huge movement towards more people doing this, which is pretty cool.
And so now having these large funds, you mentioned this earlier, right? Where when we first started, you have these large funds, they're getting involved in the market, and there's an impact on the market, right? When you have whales essentially now buying up assets, or at least playing in that same sandbox as you. How are you seeing the impacts in these different sectors? Like you talked about ESG, right? You had this fund who just mandated that all these companies do ESG. Then we found out that didn't work, didn't make any sense. Are you seeing different phenomena like that happen in these different sectors as well?
Yes. So I'll mention a few. Number one, you mentioned just how are they playing in this market?
Right.
We've seen a number of hedge funds right now infiltrating Discord and Reddit threads and acting as users to place trades with retail traders or against retail traders. We've seen quite a movement. Hedge funds playing. There's some funds out there right now that have algorithms that track all of Twitter and Twitter trends. And when the moment a tweet or something goes out, they make bets and placement. It's very interesting on how they find alpha again in the market.
Wow.
Some are finding alpha by literally infiltrating Discord groups and talking about trades and queuing trades up or trading against retail traders as well. It's very interesting. You mentioned this bigger funds like BlackRock. So you're in real estate. Mm-hmm. We've seen this in real estate. 2021, 1 in 7 homes was purchased by Wall Street.
Yeah.
2022, 1 in 5 homes was purchased by Wall Street. 2023 is about 1 in 3 homes purchased by big funds on Wall Street. These are residential homes. We are seeing, if you've ever wondered, where are all these cash buyers coming from?
Right.
Big funds. We are seeing this mass consolidation happening. The World Economic Forum says, you will own nothing and you will be happy, right? You've heard that before.
Right.
We are seeing a mass consolidation around the country. And so I believe we need more regular people to launch funds and democratize this. I'm not okay with 1 or 2 or 3 firms controlling everything. Right. I am okay with 10,000 independent firms all competing and fighting and, making a competitive marketplace, because that drives down ultimately prices for consumers. Mm-hmm. And it makes a competitive capitalistic market. We have a lot of markets right now that are not capitalist at all. They're very they run off a cartel based system or a monopoly based system.
Right. And
so I'm a big proponent of democratizing Wall Street, allowing more people to play in this game, because real estate's getting gobbled up right now. We're seeing roll ups in pretty much every industry on earth. Mm-hmm. You've heard of the big 4 accounting firms. There's a reason there's big 4. They bought everybody else. Right. The 5 media giants. If you pull up a chart or whatever, the 5 media giants control every piece of content pretty much me and you watch online. It's controlled by like 5 people.
Wow.
We think, we have all these different channels and brands and stuff. They're all owned by the same groups. We've seen this on social media. There's a number of groups buying up social media accounts. Right. You don't know it. They just look the same, but they're actually controlled in the back end. There's rumors Mr. Beast was bought by Disney. Did you hear when that came out? It was a big fallout.
I did not know that.
That Mr. Beast did a private deal for a few $1 billion with Disney, and they now own his channel. He just runs his channel as normal, but they actually are the back end owners of his channel. Many channels, a lot of them we know about. Some of them we probably don't know about most.
Right.
And so we think we're getting independent news. We think we're getting, it's all just these content creators. A lot of times they are owned and bought by these back end groups. We saw this in the 2020 election. Yeah. Michael Bloomberg was running for president. He bought up, 100 to 200 meme accounts online. They spent a few $100 million buying meme accounts. Some of them were public, some of them weren't, but they were plugging in, subtle memes that were going to favor him in the election. He ultimately lost the election, right? But it's very interesting what's going on, this consolidation effort that's happening around the globe. We're not even, it's not even before our eyes.
Right. And this is something that's really important for the audience to really take home and understand that there's a deeper why here, right? We talk about, and I don't want to get into politics, but the word is we're becoming an oligarchy, right? Where we're just going to have this top 0.1% own everything, similar to countries like Russia and countries that didn't develop in the same way that the United States did. But as opposed to being upset when you hear about this, BlackRock buying 1 in every 3 homes in a specific market, this is the opportunity to fight back, right? This is the opportunity to get involved. And even if you take this podcast and send it to someone else that is working on a specific investment thesis where they're buying a bunch of businesses or buying a bunch of real estate, this is the way to have that same lever so you can compete with these guys and these gals and these big funds that are what people are basically complaining about all over YouTube and on the news. Would you agree with that?
Yeah, the oligarchy is very interesting of, are we moving to that? Are we already there? Are we not? Mm-hmm. We will see. We'll see how it plays out. It sounds like the Trump administration has seemingly plans to really help revitalize the middle class in America, and they're making hard cuts, and a lot of people have complained about it, but what's your plan? A lot of people complain about what Trump is doing, and again, it's not perfect, but what's your plan?
Right.
The previous administrations haven't done anything. So at least he's doing something, right?
Right.
We'll see if they can really revitalize manufacturing. They've gotten about $5 trillion committed in investment to the United States in the first, 100 days. So you look at that and you go, that's interesting. And again, to not play politics, I root for whoever's the president. I'm rooting for everybody, man. I want Trump to crush it. When Biden was in, I was hoping Biden would crush it. I'm like, please, I live in America. I hope this works, man, because I live here. I want it to crush, dude. I love America. I want it to, and so we'll see. I'm hoping it works out, and I'm going to make money, whether it's a Democratic or Republican president, I'm going to make tons of money, and I'm going to figure out how I can make my family extremely wealthy. If there's going to be a wealth divide or the wealth gap separating, okay, I'm going to try to end up on the wealthy side.
Right.
As much as we love to move and shift and try to talk about, which is great to do, but ultimately, you gotta number one, secure what's good for you, right? We can go protest, we can make little tweets on our little thing and whatever, but like protests have really lost their luster in 2025. There's a protest every day about something, So the real way to win, I think, is to win at their own, beat them at their own game. Use the tools like a fun against them. And put yourself, your family, your community around you in a better position than it was before. That's how we win together collectively. Tweeting about it, going and protesting, I guess it's fine. You can do that. But I think the big needle movers are entrepreneurs who are actually doing something about it for your family, yourself first, then your family, then your community around you.
Right.
That's when you can make a lot of impact.
Looking at this in a way, there's a deeper why there, right? Where there's this opportunity where we know that we're at a fork in the road type time in history where things are going to become increasingly separated when it comes to the wealthy versus the poor, right? The people utilizing AI, the people who are utilizing the best vehicles to generate wealth, they're going to be the ones who end up on the right side of history just invariably because they're at least playing the game when others are not. Now, with that being said, how do you view these opportunities, whether it be like do you look at the less popular opportunities like the boring businesses and things like that? They're really impacting the actual community, right? Like buying an HVAC company, buying a plumbing company, whatever the case may be. How do you view those boring type businesses and utilizing funds for those, for example?
I think in general, there's a huge baby boomer wealth transfer right now happening. In general, it's a great strategy. It's a very fractionalized industry. And there's, I think, money to be made in fractionalized industries from old businesses that can be revitalized. Right. The contrary, because this has been a strong trend. I think a lot of people are like, yeah, this is awesome. We're going to do it. We're going to go crush it. Right. The contrary view is there's a lot of people heading in that direction right now. You have a lot of... I'm talking Ivy League, Harvard grads doing this as well. Right. You have people that are like, you know what? I'm going to go buy 7 laundromats. I'm going to go do the HVAC thing. And so, just be prepared. There's going to be, anytime there's a movement to something, you also face competition. We saw this with, when funnels came out and they were big, everyone was doing funnels. And then remember Amazon stores came out for like 2 years and then everyone was doing Amazon stores. And then like everyone's getting sued now because they all went fraudulent. Now everyone did like sub 2, they're all doing seller financing, right? And that's become very saturated. I think the same thing's kind of happening with now there's a lot of small businesses though. So that might not be saturated as much. Same with real estate. I would say it's a good business to be in. I would say there's good tailwinds there. There's a lot that can happen, but also I tell people every time, be prepared to run a business. Nothing is as simple as it seems ever. Oh, it's always like 4 times more work than you think. And so if you take the same mentality that you took to Amazon stores and wholesaling and funnels, and you're just like, yeah, I'm just going to try it out for a month and hopefully it works. Like, I don't think it's going to work. But if you're like, no, I'm going to go crush this thing, I'm going to make this thing work, I think you'll do phenomenal.
Yeah. And the reason why I asked that question is because we were talking about your dollar is your vote. Right. And essentially, there's a deeper why here. When you create a business, you create a fund, you create an opportunity for people, if they agree with you, with the way you think and the value that you provide, they're going to vote for that to be brought to fruition and for you to bring more to that customer base. Right. And so you can look at it as I go into my community, I create this opportunity, and I create the type of business that I think my community wants to reflect, or a sector, or my nation for that matter. And this goes back to what we're talking about. Like you have like ESG and you have all these different things where a fund, they could actually just influence all these businesses to do that. But if you look at it, what you're doing by democratizing the education behind funds and launching them, you're giving the people an opportunity to start to set these type policies in these companies that actually reflect what the community needs and not just some big fund on Wall Street. Is that kind of what your goal has been? And is that what you're seeing the direction go?
Well, I want to empower people to use these tools to their own advantage and to play bigger. And if you, which is there's different levels to every game, right? But maybe if talking back to HVAC business, if level one is you just buy your own HVAC business. If that's all you think about, you might get gobbled up by someone else who thinks a little bit bigger.
Right.
I would have you at least think through, well, could I go bigger? Could I, and bigger, what I mean by bigger, the reason they would gobble you up, back to people who vote with their dollars. You're like, why run a great business? Well, when you have economies of scale, you can charge lower prices. If you have, 10 HVAC companies and you centralize marketing and you centralize finance and you have a brand in a certain area, your average cost to service a home will go down.
Right.
And you can spend more to acquire a customer. Hence, you're going to beat out the other guy who bought the other HVAC business down the street that only has one location and you have 10 or 15 or 20 because you have economies of scale.
Right.
And so that's why I mentioned that I want more people to understand the next level of the game. And so at least to look ahead or maybe to start there, but look ahead to where they could go. Cause that's the game. I think it's not like they want to be in, they'll need to be in that game to survive. You'll need to play that game. And if you don't, you might crash and burn because someone else did play that game and comes and gobbles you up.
Right. Now that makes sense. So basically it becomes a situation as more people get access to the information and opportunities, it becomes a thing where you might have to do this in order to survive if you wanted to have a 10, 20-year entrepreneurial career.
Let me tell you two examples. These are real examples. AWS, when it launched, this is Amazon Web Services.
Right.
Amazon, if you guys don't know, AWS, is like the backbone of the internet in the world. One of the most successful companies ever. It's a web hosting platform for most of the internet that we run. Amazon launched this in I think 2005, 6, and 7 when cloud computing was coming out. They were already big. They had a lot of capital. Their whole goal, so they were like a fund. They were overcapitalized. What they did, and they put this in their book, was they put their cost to zero or a loss. And you're like, why would you run your business at a loss? They ran AWS at a loss on purpose for like 4 or 5 years. And the reason they did it, because Jeff Bezos' famous quote is, "Your margin is my opportunity." So all these other companies they're making, it was very thin margins, 5 pennies on the dollar margin, right? He's like, we're going to go negative 2 cents on the margin and we'll burn red. And so all of your customers will come to us. And it will bleed you out. And it bled out all their competitors.
Wow.
And once the competitors were gone, they then raised prices back to, $1, 2 pennies or 3 pennies or 5 pennies, and they go from there. John D. Rockefeller, I'm reading his book right now. This is the oil tycoon, Standard Oil. Right. Did the same thing. He shared this one story of a competitor. He's like, I wanted to be the dominant player of oil in the world. I had a competitor come into Pennsylvania. He was putting in new rail lines. I offered to buy him. He turned down the offer. He goes, I bought the land for their pipeline so they couldn't go around. He's like, he found a way around it. He goes, I called the railroads to help block him. The railroads had already been paid by him. He's like, I don't know what to do. So he goes, I went broader. I went back to New York. I went to his supplier of like the big oil barrels and drums. And he goes, I placed the biggest order I possibly could at that supplier. And I said, you have to fulfill my order or else I'm going somewhere else. And he said, and what happened was that supplier essentially got rid of all the other. He's like, we have to fulfill John D. Rockefeller. He's got so much money. We got to just this. And so first off, his competitor couldn't get any more oil barrels. Number two, he went to the end user in New York. He cut his cost. I'm getting balloons again on my thing. He cut his cost to pretty much zero and a negative so that all of this guy's customers would come to him and buy oil from him. And he bled out this competitor that was in Pennsylvania until he was ready to sell. And then he came in and he bought the company from him.
Right. Wow.
So this is people are like, oh, I'm just going to go buy an HVAC company and just be nice. This is a fractured industry with thousands of HVAC companies around the globe. And there might be a big player that comes to your town and says, hey, little mom and pop store, it's nice over here that you're doing this little thing. Okay, we're going to cut all of our rates 50%. We're going to undercut the whole market. We're going to bleed out all of your customers, take market share, and your business is going to die in 6 months, or you can sell to us. What do you want to do? Right. If you don't think about the next layer of having a fund in place, you go, no, we've got capital, we can survive, we can play the long game, we can actually buy you out. Like, you got to be ready for that second and tertiary effects of the game. There's always a game within a game within a game within a game. Right. When I say democratize Wall Street, that's what I want to happen. I want more of us to understand that game and be ready to play back and to be ready to play that game further.
Yeah.
Hopefully that makes a little bit of sense. I know that sounds, that's the truth though. Like that might sound harsh. That's the truth. That's how business is played in some markets.
Yeah.
I would suspect HVAC is going to see a lot of that game being played here very soon. That's why I was hesitant to mention it. I'm like, because I know people that are doing that right now.
Right.
In certain markets.
Mm-hmm. Yeah. We've had a couple people who that's what they're not necessarily doing the buying so big and dropping margins thing, but they're buying in that market and doing their acquisitions there. So yeah, that's a really good point. And to draw some correlation to the experience for people who they're stepping out into their first venture. But if you've been in a job, for example, I can think of when I worked in the construction industry, and I remember our margins from the machines that we were selling, the technology we were selling, were basically getting crushed, and there were some new competitors to the market. We could not understand for the life of us, like, why and how are they doing business like this in a way that there's no way that it's profitable. But as you just explained, that could be what's happening around you in your industry. And so there's a risk even working for companies and not understanding this, that there's a behemoth that's going to come in and they're going to try to shrink you all's margins, bleed you out. The next thing you know, they own the whole entire market. And then at that point, they can upsell, they can figure out other ways to drive revenue or whatever the case may be. But another point to mention, because people are probably having a hard time wrapping their head around this, as you mentioned earlier in the podcast, your exit multiple that you're able to get when you have more customers, you have a larger business and things like that. Some of these companies may actually be utilizing that as their way to monetize the situation by bleeding out other companies as well. So that could be like kind of like a backup logic. Is this something that you think is there a correlation between what people are experiencing at their jobs and things like that in this? Or what are your thoughts on what I just said?
No, it's spot on. It's just, there's always another game going on. I just keep you aware, especially in an industry there's not a lot of innovation, right? And, in HVAC, it's just kind of the same. Now, if there's some new innovation that comes out or something that changes, that then you can drive margins in a different way. But let's say all things being equal, that's the kind of tactics of the game. Now, in other industries, you have, like I mentioned earlier, the emergence of AI, new technology. So the game is ever changing because someone could drive margin because they just coded a whole brand new thing that's way more efficient than your platform. So they can drive margin much better for a much better deliverable. So that there's a more dynamic game there. In a flat business model like HVAC, there's not a ton of innovation going on. There is some. There definitely is some. That might be some tactics that's being played. And so just don't be surprised. Right. You might say that's unethical, that's wrong. I don't know. That's just don't be surprised when it happens. And just learn the rules of the game. Right. Furthermore, you mentioned capitalization. If you have a larger EBITDA, you get better multiples. You also can get better debt financing. You get better opportunities from banks. The larger you are, the more opportunities you have to play and take market share. And so it's not just a linear, cute game of, I just bought this little vending machine business and it's going to be fine. It might be. Who knows? You might be just fine. But what I'm saying is there's a chance someone comes to take the market. And if no one does, maybe you should take the market. Maybe you apply that strategy and go take over a market and crush it.
Yeah, absolutely.
We're seeing this right now with subscription car washes. A Wiggy Wash, Quick Quack. I don't know. And I live in Utah. There's tons of these guys popping up. They are in an all-out war. I mean, it's very interesting to see. And they're also, you pay like $20 a month, you get unlimited car wash is how it works. And they trade, what we found out was if you have 1 to 5 locations, they trade at like a 3 or 4x multiple. If you have over 25 locations, they trade at like a 12 to 15x multiple.
Wow.
So it's all about locations, and then there's cannibalization, and then there's competitors. And so who can dominate a market and get enough locations that are profitable for that high multiple? It's very interesting. These are like the car wash market. I live in Utah where we have the cookie wars, they call it. We have Crumble Cookie. We have, I think it's called like Crunch. There's another one, Chip. Yep. They've been in like literally a cookie war has been going on in my area. It's so funny. But it's the same thing. These are small, like, they make cookies for delivery. Right. But they are in all out war with each other, trying to gain market share in the customer's mind. Oh, there's a great book that I would recommend called Blue Ocean Strategy. And it also dovetails with a book called Play Bigger.
Yeah.
They both talk about this concept of market share and red oceans and blue oceans. Red oceans are bloody. The waters are all bloody and they're very competitive. Blue oceans are brand new. You can go, grow from there. What they recommend is go into a blue ocean. Don't make something better, make something different. A great example is Google and YouTube. So, people like Google is the largest search engine on earth, right? Microsoft spent a roughly $10 billion launching Bing in 2011. So 2011 till now, they spent about $10 billion. A lot of money from Microsoft. If anybody's going to displace Google, like they're coming in, we're going to fight Google. We're going to displace Google. They launch Bing. $10 billion budget.
Wow.
Market cap of Bing today is less than 5%. What they found was in a market, there is usually one or two category kings that dominate 75% of market share or more. In that case, Google dominates over 90% of market share. Microsoft came in to compete with them. 10 years later, they have less than, I think it's like 3.5%. Yahoo has like 1%.
Right.
It's like pretty much it's minimal. It's almost nothing. Safari has like, 1%. So that's Apple. Those are not like anybody. So the question is, what's the second largest search engine in the world?
YouTube, if I'm not mistaken, right?
YouTube. Yeah, I just brought it up. It's YouTube. YouTube created something different. It was search for just video, right? And they created a whole category. Google then bought YouTube for a huge number because they were a category king. Right now, Google is being displaced by a new threat, ChatGPT. It's not the same. It's different. They're not fighting in a red ocean. They created a new blue ocean.
Right.
Called AI chat search. It's actually ripping a lot from Google now it's this AI war. You got Gemini, you got other groups. We'll see who emerges in this new category. It's becoming red very quickly. But this concept of blue ocean strategy. And so can you create something that's different? Something that's not in a category by itself? Can you do that?
Right.
So back to, HVAC, these boring businesses, I like them a lot. I think they're very good businesses. The problem is they're in a competitive category with each other. And so you've got to then dominate that category. Now, the good thing you have going for you is it's fractured. And so there is no dominant category king, at least on a certain market. Could you become the category king? Yes. And I would strive to become the category king, because if you don't, 75% of market share goes to one company of a category. And the rest is, just scraps to everybody else. So can you be a category? I believe we're a category king for fund launch. We're in the fund launch, fund space. We on purpose designed that category, said we're going to become the category king of fund launch. We're launching a few new products right now to become different categories. So that's how I would think about it, and just be mindful of that game that they're entering into.
Right. So being that this is a podcast that talks to founders and investors, but kind of focus on the founders, I have this question for you. If you had to choose between buy a business or build a business, which one would you say is the right way to go?
I've never bought a business before. Funny enough, I've invested in a lot of business. I've never bought, but I'd probably build.
Okay. So build from scratch. Awesome. And next question, what would you say your number one book, if you had to recommend to the audience that they should absolutely read and it would be life-changing for them?
There's a lot. I maybe would give a few, but 38 Letters from John D. Rockefeller to his son.
Okay.
Phenomenal book. Old Ancient Wisdom from John D. Rockefeller. Amazing book. Another one, Expert Secrets, Russell Brunson. I absolutely love that book.
Yeah, it's a good
Very
one.
actionable. I've read that book probably 7 or 8 times. I mentioned a few other in this podcast. And I'm a reader of scripture. I love the Bible. I love the Book of Mormon. I love those books as well.
Awesome. And next question, if you had to go back and give your 18-year-old self some wisdom or one golden nugget, what would you tell yourself to help you in your career to get to where you are now?
Buy Bitcoin.
Nice. Buy Bitcoin.
It's like that simple. Like I've thought about it times. If I go back in time, I just buy Bitcoin.
Yeah.
And now I'm sitting here today. I'm like, I wonder what I'll tell myself in 10 years. Should I have bought more Bitcoin and crypto?
Right.
I'm a heavy crypto investor. I have a lot of crypto. I believe in that. And it's actually because of that mental frame. Like, man, if I could go back 10 years, if I would have just bought Bitcoin, I would be just fine. You know what I mean? I would have been fine today. That'd be my one advice.
Awesome. Next question. So when it comes to business and life, typically we have a framework or a personal mantra that drives everything, at least to keep us grounded in our decision-making process. What would you say is your philosophy or mantra that guides you when it comes to making these type decisions?
I'm a very God-fearing person. I pray a lot. I try to be in tune with God. I'm not perfect by any means, but I try, man. I believe God cares about every detail of our businesses and our lives and our families and everything. Right. It's not just spiritual stuff. I believe God deeply cares about each one of us. and has a personal connection with us and really cares. Is it okay if I share a story
Yeah,
about
absolutely.
This is a real world story. When I was 24 years old, I got invited to go meet with a gentleman. He brought me to maybe 24, 25, young. I go to this guy's office. He brings me in. This guy is uber wealthy. He's got a private jet, Rolls Royce, huge house. He brings me and he's like, Bridger, I have this one type of business. I would love to run a fund with it. I know you're the fund guy. I'm going to give you 25 to 30% of my empire that I have here. It's like $100 million empire. If you run it with me, be a business partner with me. And I was like, whoa, like dream come true. Like, This is crazy. We sat down, we mapped it out. I'm like, dang, this is crazy. This guy is twice my age, very successful entrepreneur. I'm like, holy crap. I go home. I tell my wife, we're like, dude, this is like what we waited for. That's what we worked for so hard. Like, this is like the moment, right? I was like, holy crap, this is amazing. So I'm like, okay, I'm going to just pray about it, see if this is the right decision. I kneel down and pray. Now, God doesn't always speak to me, but when he does, I'm like, I'm going to listen. And I got a distinct answer, no.
Wow.
Like, do not do this.
Okay.
And my wife felt the same thing, like, no.
Okay.
And I was like, wow. And I kind of reasoned with it. And I was like, you know what? If God's going to tell me something, like, I'm listening, I've tried to train myself that way. Like, again, God doesn't always speak to me, but there's certain times in my life where I feel like I have like had answers, and I'm like, okay, I'm following. So I go the next day, I tell the guy, call him up. I'm like, hey, I just don't feel right about this. I'm sorry. Like, can't do it. He's like, all right, well, you missed the opportunity of a lifetime. Like, you're dead to me, dude. Like, see you later. Kind of like that was kind of like, see you later, bro. Like, good luck. Like, you're making a big mistake. I was like, I know. See ya.
Yeah.
Anyways, I go on with my life. 3 weeks later, I get another phone call from a different guy. I go to his office, huge high rise, same thing. This guy's uber wealthy, pretty much the same pitch. Like, hey, let's be, you'll be a 30, 40% partner. We're launching $100 million fund. We have this whole empire. We're going to consolidate. I'm like, wow, holy crap. Maybe that's why I said, like, this is amazing.
Right.
I go back to my wife, same thing. We kneel down, we pray. God tells us no. And I'm like, what the heck?
Yeah.
I'm like, is this just me? Am I like off? Like, am I just making this up? But I was like, man, no, I'm a pretty faithful person. I'm like, I feel like this is God talking to me. So I called the guy up and I'm like, hey, I can't do it. I'm sorry, I'm out. And I had no reason why, nothing. And so I just went on and lived my life. I ran my businesses. I'm doing other stuff. I'm running my funds. Nothing comes of it for a year, then 2 years, and 3 years, and 4 years, like nothing. I'm just like, I don't know. I guess we'll see one day. We'll see what happens. I don't know why. 6 months ago, first guy gets raided by the FBI. He's running a huge Ponzi scheme. He's been running it for like 5 or 6 years.
Wow.
About a year ago, the second guy, huge lawsuit, was running this big fraudulent thing, like terrible. Both guys, separate, different companies, huge, like going to jail, like hundreds of millions of dollars of lawsuits, like crazy stuff.
Oh.
And I sit here, I'm like, holy crap.
Yeah.
Like that would ruin your career.
Right.
Especially for a young guy in your 20s. Like that would be a black stain that it'd be very hard to recover from.
Right.
And I'm like, wow, I am so grateful that God in his infinite wisdom and glory spoke to little old Bridger and told me, like, don't do that.
Yeah.
And secondly, that me and my wife listened.
Right.
And I share that to say I just think more people need God in their life, and that God does care. And that's one experience. I've had countless experiences with similar situations. I pray over who I hire, who I fire. And now most of the time I don't really get an answer.
Right.
But I pray about it. But there are some times where I do get a distinct answer. You should do this. You should move this way. You should go over here. And I try to follow as best I can. I'm not perfect, but if you asked about what's a true north principle or something I follow, I try to do that. And I feel it's grown, and that's in business. I do the same thing with my family. I do the same thing with my health and fitness and other things. I pray over everything. And I think sometimes we try to put God in a box that's only for church on Sunday. I think God deeply, because there's so many ripple effects.
Right.
The ripple effects, your business impacts your family, your community, your clients. The ripple effects of what you do are massive.
Yeah.
And I think it's important to pray and find God in those things.
Awesome. Very wonderful. I appreciate, the lesson, the story, and everything. Before we let you go, we have this one last question to tie things up. So hypothetically speaking, let's say that I'm an entrepreneur. I have something that I know that I can execute on, and if I just had unlimited money, I could take this to a $10 billion company by doing the same thing over and over and over again. What should I do from this moment to get involved in launching a fund or whatever the case may be?
To get involved, I would say number one, educate yourself. So I have actually bunch of free gifts for your audience if you want. We have a full free platform at funlaunch.com. It's like a full course. That's free. And then we also have altstreet.com. We interviewed 10 of the best fund managers we could find around the globe. They manage billions of dollars. We all interview them masterclass style. They look just like masterclass. It's completely free. I'm all about like democratizing Wall Street. It's got to be free. And so altstreet.com and funlaunch.com will help have those things. Number one, educate yourself. Secondly, and our whole, if you're wondering what's the secret plan, the secret plan is, I believe if we give enough value up front, that people will eventually, if you want to launch a fund, we have lawyers, we have teams, we have consultants that can help you launch. And we, yes, you spend money. It's on average $20,000 to $40,000 to run a fund through us to scale. But man, it's awesome. But we want to give free value up front, free content, free whatever to help educate the masses on this game. That's the way to connect and follow up. We post a lot of content for free online under Bridger Pennington on pretty much every social media platform. All about funds and macroeconomics and all the stuff we're talking about today. So pretty good place to go.
Yeah, awesome. So everybody in the audience, if you're interested in doing this, feel free to check him out. And to you, Bridger, I just wanted to say thank you so much for coming on the podcast. This wraps up our final segment. And to all the viewers out there, remember to like and subscribe so you'll be the first to know the next time we drop an episode here on Founders Talk. Boom.